This is the Wealth Standard Radio, your gold standard in everything financial.
Hi, everyone. This is Patrick Donohoe. Welcome to the Wealth Standard Radio. This is episode 164, and we are going to be talking about Wells Fargo today. However, for those who have attended our Cash Flow Wealth Summits of the past, we have an exciting announcement. We are going to do a mini Cash Flow Wealth Summit at the end of October. So October 27th, which is a Thursday. It's a Thursday. We're going to do it all day long. And we're going to have a number of good speakers. We'll be announcing them shortly. But if you want to pre-register, that's available on the website, www.cashflowwealthsummit.com. You're not going to want to miss this event. We have some really cool things lined up. All right, so today we're going to be talking about Wells Fargo. Wells Fargo's in the news, and they, I don't know if you call it a hand slap or, I mean, who knows these days? With these banks and financial companies, it's like, I think people are so polarized. It's like, okay, well, they screwed up then, they screwed up then, they screw up again, who cares? Yeah. Right? It's one of those things where it's happened so many times. It's people are like numb to it.
Correct.
But I have my buddy here, Chad Hanson, and him and I are going to talk about what went down with Wells Fargo and the firing of their 5,000 plus employees because of I think it was $1.5 million fraudulent accounts.
2 million fraudulent
fake accounts,
basically.
Right? It's identity theft, right?
Well, they identify that as aggressive sales practices.
Whatever. It's like that's totally fraud.
It
right?
is.
I mean, you get anybody that does like identity theft,
Yeah.
right? It's not going to be like, oh, just you can't do that. Don't, So it's one of those things where it's like, because they worked at Wells Fargo, because they work into the banking sector, they can set up, 500,000 credit cards, 1.5 million accounts, and nobody goes to jail.
That's right.
Right.
And if you think about that, if you or I did that with one of our clients, it is exactly as you labeled it, identity theft.
Yeah.
I mean, if I open up an account for a client without their permission, and I set up the PIN numbers and the access codes, and I controlled that account, and they had no idea it existed, I lose my licenses. I could do jail time. It's crazy. But this Wells Fargo thing, nobody went to jail.
They're fired. No one went to jail. The lady who orchestrated the whole thing, right, walks away. She wasn't fired, right? She has an early retirement, gets $125 million. So all this is over the headlines, right? So looking at some of your research, what was some of the response? I mean, was there anybody that was up in arms, or was it kind of just another Wednesday?
It's another Wednesday. It's business as usual. So here's kind of the key points from this thing. So Wells Fargo agrees to pay $185 million as a settlement for their quote-unquote aggressive sales practices, which we know as complete fraud, abuse, identity theft. I mean, it's just
aggressive sales
ridiculous.
Practices.
Okay.
Yeah, imagine us trying to get away with,
it was just an aggressive sales practice.
That's impossible.
Sure, just take 10 cents out of my pay and call it good.
That's the other cool thing. Okay, so the fine was $185 million, right?
Correct.
To me and you, that is like, to anybody, to any normal person,
that sounds like a lot of money.
Insanity, right?
Yeah.
But Wells Fargo, we looked up their FDIC filings from this past June, and their total assets are just shy of 1.7 trillion, right? Yeah. So we did the math. What's $185 million of 1.7 trillion?
It was 0.0001%.
Okay, so to the normal person, right? So if someone has $1 million. Right. What's the equivalent?
That's the fun thing. We calculated that out. That's $108.
$108
per million.
Per million. Okay. What about 100,000? That's like
nothing.
$10.
$10. Yeah. So
anyway.
$10 per 100,000 is what they lost.
That's
in that little debacle.
All right, so here's what went down. I mean, Wells Fargo. You look at just banking in general, and I think in the financial world, there's tons of pressure, right? And we've talked about in the last couple of months. So we talked about negative interest rates. We've talked about stimulus and what the Federal Reserve is trying to do, right? And it's really creating a ton of liquidity in the markets. But most people don't realize that liquidity, okay, or when there is stimulus from the Federal Reserve, it has to go through the proper channels to actually get out into society.
Correct.
Right? They can't just even though Ben Bernanke has a nickname of Helicopter Ben, right? They can't just go out and throw money out of a helicopter, right? They have to go through the right channels. So they either have to go and buy bonds, they have to go in and increase the leverage that banks have, right? Increase their capital, increase their accounts. They can mess with interest rates. They can mess with reserve requirements. I mean, there's a lot of different ways in which they can do it. But for the most part, they're either using banks, right, or using bond buying, right, using bond auctions, mostly with government bonds. Okay, so looking at Wells Fargo was a big recipient, right, of stimulus money back in 2008, 2009. Okay, and they were in a sense kind of put into a corner, painted into a corner as far as all the other subprime stuff that was out there, because they didn't really participate in a lot of subprime. That was mainly like Countrywide, who was taken over by Bank of America.
They got held
Lynch.
up in that as well. I mean, if you look at we'll talk about this maybe later, but yeah, they just settled earlier this year a $1.2 billion fraud settlement for their lending practices from stemming back to 2008.
Yeah,
so they say they have some issues involved there as well.
And looking at the associated with 2008, 2009, I mean, you really look at the main players there, and you look at all the these different types of mortgages, whether the negative amortization mortgages or ARM mortgages and subprime, right? Because Bank of America is the one that took a huge hit when they were forced to take on Countrywide, right, which was a time bomb. But anyway, getting to the point of this, it's like you look at the pressure that is placed on banks and on any financial company, right, and they're kind of struggling as well right now, because Wells Fargo, they have $1.7 trillion in assets, right, but they have like $1.5 trillion in liabilities.
Correct.
So I think this is a good distinction, and this kind of gives those that are listening an idea of why were they doing this? What was the incentive of Wells Fargo to, number one, have their employees compensated or incentivized to open up new accounts, open up new credit cards, right? And then obviously it was all orchestrated, but why are they incentivized to do that, right? So let's just kind of do some banking 101 here. So first thing is, when a bank receives a deposit, right? When they receive, your paycheck, and it's inside their accounts, what do they book that as? Like on their balance sheet, on their financial statement, what is that booked as?
Well, it's both an asset and a liability to them, because they have to pay that out to you when you request it.
Okay. So, but in the beginning, it's a liability, right? Because if they have to pay it out, right, that goes on their books as a liability.
Correct.
Right. So it's something that is owed. Now, to us, it's an asset. Right. And it goes into the vaults, but it's kind of like the banks are borrowing from us.
Correct.
Right. Because
we become their lenders.
Exactly. And it's a very liquid loan. Right, they were giving to them. It's not like a CD, which is like a time deposit. These are more demand deposits, which is, if we go and demand it, they will give it to us.
However, they're becoming more like CDs every day, because you have certain deposit requirements, or you pay fees.
And I want to talk about that too. But I would say, the first thing, Banking 101, is when they take on a liability, okay, then you put a liability, and if you have more liabilities than assets, that's not a good situation to be in, right? And so you have banks that are taking on tons of liability, because these days people are not spending money. They're saving more. They're a little scared. They're anxious. So banks are taking on more deposits and more deposits and more deposits, okay, and creating liabilities. Now, what they do is, in order to offset that liability, is they go out and they issue credit, right, which is an asset to them.
That's why every bank is pushing their credit cards, their debit cards, their all kinds of different cards.
Points.
A litany
they're
of cards.
paying Tina Fey. They're paying, Samuel L. Jackson to get on there and, promote credit cards or whatever, because they want people to go into debt, because that's an asset to them. But here's the problem, okay? People are saving. They're not spending, right? They're not going into as much debt as they were before. Number one, they're not making any money, right? You look at employment numbers, and it's like, okay, employment numbers are improving, but at the same time, it's more of like, part-time work or underemployed, right? So the idea is there's not this, the society right now does not want to spend. Right. And when they do, it's very nominal, and they don't spend credit. They're spending cash. But that kills banks, right?
When you look back at the history, what hit me in these series of articles that came out about Wells Fargo was really exactly that point. 2008, 2009 scared the pants out of everybody. Everybody went into this shock and kind of reeled back and said, wait a minute, we shouldn't be buying this. We shouldn't be leveraging so much on our debts. We shouldn't be going into debt for entertainment centers and TVs and cars. Let's hunker down a bit. And that forced the banks to change. So when they look back at these fraudulent practices from Wells Fargo, they started in 2010, 2011. So it's when the banks then started saying, wait a minute, people are saving money.
Yeah.
This is a problem.
Well, here and
we need to generate more money.
This is a great point, because think about it. Back then, right, when Wells Fargo got a huge stimulus, right, when you have Bank of America, they got a huge one. Chase got a huge one. Okay, all the big banks, essentially to preserve not preserve, but prevent a run on the banks, they gave all the big banks money, right? Some banks didn't need the money, right? They're like, no, we're fine. We didn't mess around like you did. We're fine. But they gave money to everybody, right? So everybody, was kind of considered equal, because if they didn't, they gave it to Wells and not Chase, it shows that, wow, Wells is in trouble, Chase is not. I'm moving my deposits from Wells to Chase, right? So they gave everybody liquidity. But here's the thing. If you go back and look at what interest rates were, right, on like treasuries and bonds and so forth back in that time, okay, they were much, much higher than they are today. So what was happening is all this liquidity was going into those coffers, right, and they took that, and instead of lending it to the American public, which was the whole, whatever the political terms were, but that's what, they wanted the banks to do, is to create velocity. They wanted to create liquidity for people so they can get, back on their feet. They didn't do that. Yeah. They basically took on hundreds of millions, billions in stimulus, and went out and bought government bonds with it. Right? So they took money at like zero and went and bought government bonds at 4 or 5%, right? And that's like a 400 or 500, because again, when you take on liquidity,
that's money for nothing.
You have to offset it with an asset, right? And I don't blame them. I mean, looking at banks, it was a smart decision for them. It was a stupid, idiotic decision for Ben Bernanke at the time, and Hank Paulson, who was the Secretary of Treasury, right?
The American taxpayer.
But I kind of argue like, well, they're not idiots. But anyway, I'm not going to get into that. I'll go
so
off
basically,
on that
the American
trail.
taxpayer just gave the banks an extra 45% on top of everything they did. For sure.
So that's my, you go back to that, and then you look at right now. So when Wells is taking all these deposits, okay, you don't have the same spread that existed in 2008, 2009, right? Today, you look at like the 10-year. The 10-year is like, it's nothing. The 10-year, the 10-year, which is considered kind of one of the benchmark, it's not short-term interest, but it's not, a 30-year bond, long-term interest. It's right in the middle. But the 10-year is like nothing, right? It's like, it's way less than 2%. I don't even know what it is. I haven't looked at it in a while, but it's insane how low it is. And so they're not, if it was like 4 to 5%, I guarantee that this fraud would not have happened, right? Because it's easy for the banks to actually go out and take and buy on that asset.
Well, yes and no. I mean, this practice has been around a long time. They call it "quote unquote" sandbagging, and
has it been so? All right, so you did more research than I did. So
they've been doing this for forever, for a long time. But it got worse in 2010, 2011 when they needed cash. Okay. So the concept of sandbagging is basically to hold something back. Like if a flood's coming at you, you fill up the sandbags and you line the streets so you don't take on the flood. Yeah. So basically, what was happening is they were seeing the flood coming. The pressure was mounting and rising, and they decided, hey, let's sandbag some of this money for later, and that's what caused all these accounts to be opened up. They said, you know what, we need this credit, we need all these accounts on our books to satisfy our stockholders, to keep the wolves at bay on Wall Street, to make sure that we're okay. And it just got worse and worse and worse and worse, and it went up the chain. So it wasn't just a couple accounts here and there; it became the widespread practice. Somebody comes in. They don't have all the bells and whistles and alarms set up on their account. Hey, open up a few more accounts for them. Yeah. Suppress the statements so they're not alerted about it. Let's open up a few more accounts. No harm, no foul. Jeez. Well, the problem is eventually some of their safety systems, if you will, shut down, and people started getting charged account fees and charges for these ghost accounts. Yep. And they finally called and said, what's going on? I never opened up this credit card. Why am I being charged an account charge, a maintenance fee for this? And so that's really what happened is this widespread practice that was fairly controlled for many years finally got out of control. And
whether it has been around for a number of years or not, it's still, it's uncalled for, and I think it's fraudulent. Right. I'm actually surprised.
And they're not the only bank that does it. I can guarantee every banker and even a lot of the credit unions out there are probably doing some of this, and not maybe for the same reasons, but they're, if you think about it, the employees who were doing this wanted to keep their numbers higher because that's how they were bonused.
That's how they were bonus incentivized. Yeah.
Yeah, the more accounts you open up, the more money you make. So what's their incentive? Of course, to open up as many accounts as they can, whether they're valid or not. You know some of that's going to happen.
Yeah. Well, looking at this again, it's I think the reasoning behind it, there's so much to do with, again, that pressure and the need for them to acquire assets, right? And right now, the only attractive assets that are out there are not being purchased, right?
Yeah.
Or the yield simply does not work within their revenue models. So, I mean, I understand why they did this, right? Because they needed assets, right? And if you put, 500,000 credit cards on there, right? They have, 10, 15, 20% interest rate associated with it. Great asset.
Yeah.
Right. And I'm assuming they were able to package those, right, with a credit people. Right. So anyway, people, because again, if it's somebody that uses credit a lot, they're going to know whether there's something on their credit report. But if you have a person with no, that has no debt, they're not going to notice that. And so there'll probably be a credit people that are not paying attention. And that's why,
unfortunately, it was probably seniors. It was probably the 85-year-old grandma. Yeah, your grandma.
That's never used credit in her entire life.
Exactly. She doesn't check her credit report. She doesn't. She's not worried about it.
Well, so so it'll be interesting to see kind of how it plays out. I know you were doing some research on the stock price, because I was over the weekend. I had dinner with Andy Tanner, and who's been on the podcast before, and we were talking about this very subject, and he was kind of talking about the past, which was enlightening, and this is kind of what the discussion went to. So you look at Wells Fargo. First off, you don't wake up one morning and say, "Hey, let's fire 5,300 employees," right? They've known about this for a while, right? And I guarantee with, Warren Buffett as a major shareholder, Berkshire Hathaway as a major shareholder, you're not going to come out with this type of news like, on the spur of the moment, right? This is all orchestrated. It was all coordinated. It was all strategically done at certain time periods and so forth. So you look at it, and really, what Andy said, he said, "Listen, this is in the past, and you can tell me what happened with Wells Fargo share price. But in the past, if you look at some of these similar events with banks, right, they're trying to get their exposure. They're trying to get rid of exposure. They're trying to reduce expenses, and if they're able to do that, their quarterly filings are going to come out, which should be out. And they come out when? October?
Yeah,
I think quarterlies come out. You look at that, and then bam, their share price will pop because they were able to do this in the third quarter. So why don't you go through? It was a fascinating conversation with Andy, but why don't you go through kind of what happened to the Wells share price, and then what's happened in the past, and what we can anticipate in the future.
Yeah. So maybe first, before I get into that, much like we did that calculation of $185 million fine to the $1.7 trillion they have in assets, it ended up being nothing. Yep. 5,300 employees being laid off. Again, to us, that sounds like a monstrous, just a huge amount of people. Yeah. But to them, it's nothing. That's less than 1% of their employees.
Yeah, I looked at that too. So they have 233,000 employees.
Yeah, 5,000. That's a drop in the bucket. It's nothing. Yep. So to Wells Fargo corporate, that means zero. To all those families that were affected, it's huge. Yeah. Okay, so again, it's the corporate versus the individual. But as far as their stock price, I found this really interesting. I looked back in February 3rd, it was announced that Wells Fargo had to pay $1.2 billion in settlement over the fraudulent mortgage practices stemming from 2008. And what happened to their stock price back in February? So if you look at February 1st, the day prior to the announcement, they're trading at 49.94. February 11th, after the news had hit and they hit their low, they're at 45.16, which is a 10% decline. Just 11 days later, February 22nd, they were back up to 49.9. So they were at normal trading volumes. Oh, and that's the other thing. So it took less than 2 weeks for their stock to recover. When the news first hit, there were huge high trading volumes because everyone was saying, "Oh, sky's falling. Get rid of Wells Fargo stock. It's going to plummet." But then within 2 weeks, they were right back to where they should have been with normal trading volume. And what I found interesting is that it wasn't that people were capitalizing on the low stock price, because the stock price or the trading volume, didn't increase after they hit their low. It stayed at normal levels. So if you think about why, well, it's basically just because all of us here have been trained to go like sheep and just invest in our mutual funds and our 401k plans like clockwork.
Which means we're not investing. They're invested for. It's investing for us.
Exactly. So people were just blindly putting money back into Wells Fargo stock, regardless of what happened to the news. So they had a $1.2 billion settlement paid out. In 2 weeks, they're back to all as normal. The same thing happened this time and will happen this time. So if you look at what's going to happen here. I mean, September 1st, before this news came out, they're trading at $50, 50.43. September 8th, just the day before the news came out, 49.9. So they're pretty even. Not a lot happening, little minor fluctuation. News hits, they drop to 46.8. Again, another 10% decline with high trading volume. But if you look over the next 2 weeks,
it'll be interesting to see what happens.
You're going to see
just go right back
you're going
up.
to see normal trading volume.
But once quarterly comes out,
and their stock price will go right back up to where it was.
And once their expenses are less, once their exposure is less, boom, they're going to have some equity and value.
Yeah.
It's just interesting how that all plays out. And I think, and this is a topic for another day, but I asked the question, a number of years ago. It's like, okay, you have these $1.2 billion fines. You have $185 million fines. You have huge fines elsewhere, right? Where do those fines go, right? They go right back to the government who gave them stimulus to begin with. So
exactly.
It's just an interesting kind of shell game, right, as far as how all of this is concerned. But something else I found interesting, and then we'll kind of get to the point of why we're covering this today, because there is a point, and it's not to buy Wells Fargo. Just letting everybody know. But if you know what you're doing, I guess that's okay. But so looking at the woman who is in charge of this, I want to talk about her, because it's interesting, because the articles that I pulled up, it talked about this woman who had been there for almost 30 years, Tolstedt.
Yeah, Carrie Tolstedt.
No prison time, right? And they didn't even fire her. Okay, right. She decided to take early retirement. Now again, when you're orchestrating this. Okay, when you're basically, because I guarantee it was like, okay, you're the fall guy. It's all on you. You're going to retire, but you're going to keep your $125 million compensation package, right? So it's one of those things where, the whole thing was orchestrated strategically so that it would not create a run on the bank, right? Which I'm going to give a quote here from the bank in just a second, which is kind of contradictive. But, you have her kind of leave. Nobody goes to jail. People are fired. Nobody has any type of personal liability associated with it. Okay, then you have this statement that comes out from Wells Fargo. It says Wells Fargo reached these agreements because we're committed to customers and the interest of putting this matter behind us. Wells Fargo is committed to customers' interest first 100% of the time.
And what's interesting is that's just the public statement.
Yeah.
Their legal statement was very different.
Yeah, because that's not because their fiduciary responsibility, right, is not to customers.
No.
Right?
To
their
their
fiduciary responsibility is to their shareholders.
Correct.
Right? It's to the owners of the company. Their loyalty is not to customers. And that's what's fascinating is you say this, but again, what's the reason behind saying this? They don't want to run. Right? They don't want people to kind of run to Wells Fargo and withdraw all their money, because that creates, a bank run. Because if everybody starts withdrawing their money at the same time, that's when you have major issues. Because as you were mentioning a few moments ago, right, banks are basically it's more and more difficult to hold money at banks, right? They don't want to, you can't withdraw more than $1,000 in cash with them, like, putting you under a spotlight and, calling the FBI to come and, you have to explain why you need cash, right? It's becoming more and more difficult to get liquidity, right? And at the same time, you have a lot of fees associated with what's going on. Plus, you have a ton of oversight and transparency when it comes to your accounts and who can view those accounts, right?
Correct.
Which is pretty much anybody these days.
Oh yeah.
So you look at
like
kind of the
every employee at any level at Wells Fargo.
Yeah, that's seriously, and that is another scary.
So many people have access to your accounts that you don't even know.
It's unbelievable. Anyway, so I look at you look at a lot of these statements. You look at what happened to Tolstedt, and you just a lot of things just to me don't make sense, right?
No.
A lot of what they came up with is placating the public, which I understand, right? But at the same time, this is just more proof. We've been talking about this for a long time, which is you look at just the incredible imbalance between the scales of justice of Wall Street, banks, and the public, right? In the end, the people who pay the price for this is the public.
Correct.
Right? All the stimulus, all the liquidity that exists right now, okay, it is basically inflation killing the purchase price or making the purchasing power of our currency, of our money, okay, volatile, right? But it's also playing with people's retirements. It's playing with pensions. Because most people that think, okay, well, I have gold or I have, insurance policies and I have real estate, right? You're still affected, right? Because the economy is so dependent on what's going on in Wall Street, what's going on in the banking sector, that anything is going to affect us, whether it's deflation, inflation, whether it's taxes. Because in the end, right, who's the one that paid the price when there was a huge stimulus? American public.
The American public.
Right?
That's
Because the government went into more debt. Now they have $20 trillion of debt. How are they going to pay that back? The interest and the principal comes from taxes, which is us. So it doesn't matter. And you may say, well, I have a self-directed Roth IRA, or I have a 401k and it's self-directed. I have real estate. It's like the taxation associated with anything is subject to change, right? What exists now is not guaranteed. And that's what most people don't understand. Even with like a Roth, right? You think with a Roth, okay, it's going to be tax-free for life. It's like, okay, yeah, according to the current law, but that's a statute, right? That's the revenue code. The reason why there's 20,000 pages of the revenue code is because they've made changes over time, and they will continue to make changes
every day.
And it all applies to the revenue that they need to survive.
That's right.
So you look at a lot of the stuff happening. It's like, okay, well, I don't have money at Wells Fargo. I have money at Chase. Or you say, well, I have, I don't own Wells Fargo stock. I own, I own Bank of America stock, right? Or I have a mutual fund, but the exposure to the financial sector isn't that big. It doesn't matter, right? The economy, society is so interwoven that all of this is going to affect you.
Correct.
So looking at what we've been preaching, the original purpose behind banks made sense, which was they will store your wealth in a safe and secure place, and they will give you a receipt that you can go out and efficiently trade. But it's become a mess.
It is.
Right? And that's not what the original intention was. No. But society has basically come to this conclusion that, where we put our money is a bank, right? And that there's nowhere else to put it. And it was interesting, and I know you have a comment, but it was interesting. I was listening to Malcolm Gladwell's podcast, the Revisionist of History, I think it's called. And it was a fascinating podcast, but the episode that really stands out to me is the one where he did a kind of a whole episode on Rick Barry. Rick Barry was a famous NBA player that had some of the highest percentage of free throws during his era, but he shot underhand.
Huh, interesting.
Okay,
I didn't know that.
And Malcolm Gladwell went in and he basically, because Rick Barry and basically the theory there was you're biologically more likely to make a free throw shot underhand than overhand. But nobody else, like Shaquille O'Neal, didn't want to do it. And they had all sorts of very famous players that were horrible at free throw players.
Dumb.
They were afraid of looking stupid.
Yeah.
Right? And it was so counterintuitive because it's kind of like, well, basketball is getting the ball into the hoop. Does it matter how you do it? It's kind of the hook shot, right? The hook shot. So anyway, the idea behind banking and why I use that example is that people are they become so acclimated to saying, this is what I do with my money, this is where I put it, this is what, and I don't know what it's going to take to like disrupt that, right? I don't know.
It's going to take a lot of time and some major upheaval.
Yep.
Because
this isn't going to do it.
It's going to take a complete collapse of the markets.
Yeah.
And it's, I don't know what's going to change it because it's been the norm for so long.
Yep.
I mean, ever since you were born, you were taught, put your money in the bank, invest in mutual funds, max out your 401k.
Put the rest in a Roth IRA.
You're going to be in a lower tax bracket when you retire.
Yep.
I mean, that's just been the norm for forever. But none of that is true. Yep. None of that works.
Yep.
Tax deferral is not your friend anymore.
Nope.
It's your enemy.
Yeah.
In an increasing tax environment, that is the worst thing you can possibly do.
Yep.
Putting money into your mutual funds, letting someone else, quote unquote, manage that money is not happening, and because of the plan charges, the fees, the management expenses, the ticket charges, the trade charges, the third-party administration fees, you're not getting any of that money back anyway.
And
banking, if you do, it's taxed.
And banking's the same way, right?
Yeah.
Because banking, you have a checking account or savings account. Look at the fees you're paying for
it's
accounts.
Ridiculous. Yeah.
Right? And you look at the millions and millions that are being made on whether it's wire or ACH, or there's so much. They're trying to milk you for everything.
Yeah, they are.
So in the end, I mean, the idea here is, listen, in order to efficiently spend money these days, you need a bank, right? You need a credit card, you need a bank account. But as far as a storage of wealth, that's where it gets dicey. And so looking at the perpetual wealth strategy, what we do, and our model It's basically to mitigate the risk associated with what we've been talking about all day.
That's right.
And so in the end, I mean, you look at Wells Fargo. I don't bank with Wells Fargo. I actually used to bank with Wells Fargo.
I do actually. Been there for 20 years.
Really, and it's one of those things.
So I wonder how many other accounts I have that I don't know about.
Yeah, and that's the thing is, and this is another important thing I would say in regards to just financial education and financial responsibility and management is know your credit report. Most credit cards these days will give you a free credit report every month, right? American Express, if you have an American Express card, they will give you a free 3-bureau report every single month, right? And you can learn not just what your score is, but what's on there. And I actually wasn't planning on saying this, but over the weekend, my card got stolen, my American Express card. I had like $40,000 in charges in less than 3 hours.
Wow.
They spent money at Barney's, they spent money everywhere, and they declined all the charges, right? And I have no idea where because I don't use that card a lot.
Wow.
I don't know where they got it, but in less than 3 hours, I had tens of thousands of dollars of charges on there. It was insane.
Wow.
And so looking at your credit report, looking at, who you bank with, being able to base your feeling of security and your feeling like you are in charge or in control, you have to take that to the next level, whether it's credit monitoring or whether it's repositioning assets. There's so much you can do in order to mitigate the risk. It's impossible to eliminate it, but you can definitely do some things to mitigate and buffer it.
Yeah.
So
do your homework, do your research, check up on everything you have, call on things you're not familiar with. If you look at your credit report and it says, I've got 3 Wells Fargo accounts. Yeah, that probably is right. And then you see a few others. Well, call on them, find out what they are.
Yep. And we've mentioned this before. There's a few documentaries and also some videos that some different organizations have put out that I think are valuable. And I didn't plan on listing these, and I'm sure I'm going to mess a few of them up. But the first one, the Mises Institute has so many different resources on their website, and they have a whole history of banking, right? So we'll try to find that YouTube link and put that on the show notes. But that is a huge resource just to understand how the banking world works. Okay, and then there's a few films as well as documentaries that are out there that I think are definitely worthy of watching if a lot of this is foreign to you. Okay, so the first one's called Inside Job, and we've mentioned this if you've been listening to the podcast for a while. We've mentioned this on there, but we'll put it in there again. So Inside Job is one. There's also a few others that I think are really good. Let me pull them up here. Okay, another one which we discussed recently is The Big Short. The next one is actually it's okay, but it's called Money for Nothing, which is a documentary. This one is it's an actual film. It's an HBO film called Too Big to Fail. Okay, and that's probably a good list for now. That'll keep people busy for a while. But anyway, there's a lot of others that are out there that I've seen. They're just not coming to mind right now. But really, education around how the whole system works it's going to help you because, really looking at our economy today, looking at society, despite what's gone on, despite a lot of the changes that are occurring, people are still behaving the same way. They're still doing the same things, and they're thinking that somehow it's just going to work itself out. And I would caution you, if that's the mentality you have, then it's time to think a little bit differently. So that's all I have today. Do you have any final words, Chad? Before because you worked in kind of the Wall Street securities and financial planning world for a while, and you know how the game works, right?
Yeah.
These are companies that want to make a profit, they want to make revenue, and there's nothing wrong with that, I don't think, because there's not. But doing it the right way is there's kind of there's lots of gray area in society today. And this is a perfect example of gray area because they're allowing people to essentially commit identity theft, fraud, right, to turn a profit. And there's no jail time. Mm-hmm. There's a nominal, tiny fine. Just a slap on the wrist. Not even a slap on the wrist. That's just like, they'll pull like an arm hair. Not even a slap on the wrist.
Yeah, it's a pretty minimal for what they've done and what they've what has happened. It's nothing.
Cool. All right. Well, that's all we have today. I hope you guys enjoyed, and we will talk to you next week.
You've been listening to the Wealth Standard Radio Show, your gold standard in everything financial.